December 18, 2024, will be etched in the minds of investors as a day of reckoning. It was a day when the financial world seemed to come to a standstill, and panic spread like wildfire. The Dow Jones Industrial Average plummeted by over 1,000 points, marking its 10th consecutive day in the red. This unprecedented drop sent shockwaves through the financial community. The S&P 500 shed nearly 3% of its value, while the Nasdaq Composite tumbled more than 3.5%. Investors were left reeling as they watched their portfolios shrink. The market's freefall was triggered by the Federal Reserve's latest policy decision. The announcement caught many by surprise. While the Fed delivered a widely anticipated interest rate cut, it was the accompanying projections that spooked investors. The future outlook seemed far less optimistic than expected. The central bank now expects only 2 more rate cuts in 2025, down from the 4 previously forecast. This revision signaled a more cautious approach. This unexpected hawkish tilt sent shockwaves through the market. Traders scrambled to adjust their strategies. Investors, accustomed to the Fed's accommodative stance, were caught off guard by the sudden shift in tone. The abrupt change left many feeling uncertain about the future. The market interpreted this internal discord as a sign of uncertainty and potential for policy missteps. The fear of miscalculation loomed large, adding to the overall anxiety. The Federal Reserve's decision to cut interest rates has been a significant move in the current economic climate, while simultaneously signaling a slower pace of future cuts, indicating a cautious approach. This reflects the challenging balancing act facing central bankers globally as they navigate through uncertain economic waters. Concerns about a slowing global economy and potential U.S. recession loom large, adding to the complexity of their decisions. The ongoing trade war with China, slowing growth in Europe, and Brexit uncertainty have darkened the economic outlook, creating a perfect storm of challenges. Lower interest rates are seen as a way to stimulate borrowing and investment, providing a much-needed boost to the economy. However, inflation has proven more stubborn than anticipated, complicating the Fed's efforts. The Fed's preferred measure of inflation has consistently exceeded expectations in recent months, raising red flags. This stickiness in inflation raises concerns that further rate cuts could risk igniting an inflationary spiral, which would be difficult to control. The Fed's latest projections suggest growing concern about potential inflation acceleration, highlighting the delicate balance they must maintain. Federal Reserve Chair Jerome Powell explained the rationale behind the decision to slow the pace of interest rate cuts. Powell emphasized the Fed's commitment to supporting economic expansion and achieving its 2% inflation target. He acknowledged that the economic outlook has become more uncertain and inflation more persistent. Powell pointed to the recent uptick in core inflation as a key factor. He stressed the need for vigilance in monitoring inflation and readiness to act decisively. Beyond inflation, Powell cited heightened uncertainty from the U.S.-China trade war and potential Brexit fallout. These factors have already weighed on business investment and global growth. The market's negative reaction to the Fed's decision was swift and severe, sending shockwaves through various sectors. The yield on the benchmark 10-year Treasury note surged by nearly 11 basis points, marking a significant shift in investor sentiment. This sharp rise in yields reflected investors' reassessment of the Fed's policy path, indicating a more cautious outlook. The move higher in yields put pressure on rate-sensitive sectors, particularly those reliant on borrowing. The Russell 2000 index plummeted by nearly 4%, highlighting the vulnerability of smaller companies. The real estate sector also suffered, with the Real Estate Select Sector Spider Fund tumbling close to 4%, reflecting broader market concerns. Higher interest rates make it more expensive for real estate companies to finance operations, adding to their financial stress. The technology sector, a major driver of recent market rallies, faced intense selling pressure as investors moved away from high-growth stocks. The Dow Jones Industrial Average's historic 10-day losing streak contrasts with the broader market indices. The Dow's price-weighted structure makes it particularly vulnerable in the current market environment. Higher-priced stocks have a greater influence on the Dow's performance. The S&P 500 and Nasdaq Composite are market cap-weighted, meaning larger companies have a greater impact. In the current environment, investors favor growth-oriented companies in technology and healthcare. These sectors are underrepresented in the Dow, which has more companies in industrials, financials, and energy,